So this is the year that you are ready to purchase a home, and you've been saving up for the down payment, and you're focused on a $300,000 purchase price. So an FHA loan would require 3.5% down. It's about $10,500. If you're doing a conventional loan, and let's say 5% down, well, it's $15,000. And you're feeling really good about the whole situation until you realize that there's also closing costs, which are on top of that. You can't finance them. So now we run into a situation where where's the rest of the money coming from? And if you just use an estimator of about 2%, and it could be higher, lower, but let's just use 2% for now. On 300,000, you've got to come up with 6,000 more. And if you've saved enough, just enough for the down payment, we've got to find a place for the rest of the money to come from. Now, we suppose that it could be a gift, maybe some sort of a credit if you got creative with your lender. But more importantly, what if the seller was willing to contribute? Maybe their home is priced at $300,000, but they'd be willing to take less, maybe $295,000. Well, what if we went to the seller and said, listen, we'll give you your price, but we want it on our terms? What does that mean? We'll give you the $300,000, but give us $5,000 back at closing from the proceeds of the sale. Because if they just drop the price down to $295,000, it gets you a lower price, and that's cool. But it doesn't get you an allowable way to get closing costs introduced to the equation. But if you pay $300,000 for the house, and then they credit you $5,000 at closing, it can be used for your closing costs, your prepaid items, or anything that's on the settlement statement. And that could be lender fees. It could be a rate buy down. It could be the closing fee, the homeowner's insurance, and any number of other items that could be included. Now, I want you to keep in mind that if you do that sort of creative contract writing, the home has to appraise for the top line, the $300,000, not the net, because the net is $295,000. $300,000 minus the $5,000 is $295,000. See, that's what it feels like to the seller. They're really getting $295,000, but we're writing it up as $300,000. It's completely legit. You can do this, but it's got to appraise for the $300,000, not the $295,000. And I bet right now you're saying, well, what if it comes in short of the appraisal? Well, it can. And if the appraisal comes in at, let's say, $295,000, the first thing the buyer's going to say is, hey, I need you to drop the price to $295,000 because that's where the appraisal came in. And the seller's going to say, sure, we'll drop it to $295,000, but we're taking away the $5,000 concessions because that's what I was netting, and that's what we agreed to. So if you want the lower price, not a problem, but we're taking away the concession. It's the same net to the seller. Well, now you run into a different problem because now you don't have the $5,000 for the closing costs, so we're in this catch-22. Now, the only way to overcome this is, well, let's start with coming up with $5,000 more from someplace else because you got to cover the gap. Now, if you can't cover it that way, maybe the seller just really, really needs to sell and for their own reasons decides, you know what, we'll drop the price to $295,000 and still give you the $5,000. We'll take $5,000 less just to sell the house. You know, occasionally it happens. And I'd want you to keep that in mind. But there are deal breakers in here. There's not many places left to get the money from. You can ask it from your real estate agent. They may or may not want to do that. You can ask it from the lender. They may not be able to or not want to do that. You could now be looking at a gift letter from an immediate family member. That might be a parent, a brother or a sister. You know, not a girlfriend or a boyfriend, not your third cousin, not your best buddy, you know, from the gym. It's got to be a direct family member. In a gift letter, they've got to write you a check, send over the bank statement. You know, it's going to be verified. So there's a lot of pieces to that puzzle. So when we're creating these deals where there is closing costs being paid for by the seller and keeping in mind it has to appraise out, we want to do our homework up front and make sure that the price that we're offering is going to hold up, at least in theory, with some data to appraise out. So there's a little bit about how we overcome the shortage of money for the closing costs. If you got questions about this or just want to have more information about the topic, drop a comment below. Definitely subscribe. This is Ron Weiss-Sikarski for the Black Hole of Real Estate.